Okay. Good morning, everybody,
Good morning.
and welcome to today's discussion. Today's discussion that Jan and I are going to have is about something that both of us are very passionate about. And we've got a very good reason for being passionate about, not just the fact that we've both been in credit for many years,
Yeah.
but the fact that if you're in business and you sell goods or services on firms, I think a credit policy is a no-brainer.
100%. It's something you must have.
Yeah. Why? Because if you want to become a profitable business through credit, you need to have some rules around it.
Okay. Right. So I think today's discussion, as you might have noticed, is around the credit policy. And if I think about a credit policy and me being a credit manager, that was something that had to be enforced. That's something that had to guide me. That was something that I referred to if I needed some sort of information regarding the credit environment in my business.
Yes.
So why, in your opinion, is a credit policy important, firstly? And secondly, where should it come from? Who should be driving this whole thing?
Well, the drive, if it's not accepted by your C-suite, the credit policy is never going to work.
Okay.
So you have to engage with your C-suite and they must accept. And once they've accepted it, they will drive the policy down.
Okay.
It won't even be a thing of drive, because if they've accepted it, it'll just flow down.
Okay.
Very important part of that whole credit policy process and the acceptance of it is it creates accountability, it creates stability, and everybody knows who is accountable for what when they look at the credit policy.
Okay. So what you're saying is that when there's a credit policy, it's not just a piece of paper or a document that's there. It must be adopted, it must be enforced, it must be driven from the top down. Because obviously, if the C-suite people do not agree with this, if they don't enforce it, if it is not a guide in terms of what you should do, the whole thing is just a paper that's lying there, right?
And the most important part is the C-suite must abide by it as well. Let's use a simple example. If a policy has a certain rule like levels of authority, we're going to get to that, and it says that for this specific functionality, only so-and-so can sign it off. The C-suite mustn't override that, because then everybody sees that and they start doing the same. The policy
100%.
must become like that guide, that when you walk into any business, the first thing they do, they say, here is our credit policy. Read it, understand it, and sign that you've accepted it, because you're going to live by it.
100%. And obviously in the credit policy, there's room for people or certain levels of authority to override a decision based on their mandate, right? So those things we'll cover on as well. But the three talking points we want to touch on today is, firstly, you've got a credit policy, it is developed, it is updated, and it is applied. Utopia, that works perfectly. The second scenario is then you've got a credit policy that is developed and it is not applied. And the third scenario is there's no credit policy.
Yeah, and in that second one, people say, oh, you must have a credit policy. So they write the policy, but when you go and read it, it's outdated.
Yeah.
So you can't enforce it in any case, because
100%.
the rules of engagement change daily in the world of credit. As you and I know, the POPI Act was just recently introduced in South Africa, and that has changed. So immediately, your whole credit policy and the adoption of it must be re-looked at. So now you must go and train everybody and say, hey, you're not allowed to say that. You're not allowed to do that.
Sure.
That is now a new rule in the credit policy.
It's a living document.
And that whole acceptance must be happening again right from the top, to make everybody understand where this new change came from, why the change is there, what is the effect of the change, and what, worst of all, is the punishment if you don't do it. I'm talking about the legal punishment in law, and not just by what if you break the policy.
Of course, So the first scenario is, obviously, you've got a credit policy, it's updated, that it's applied. Perfect, well, that's fine, no worries.
It's okay.
We don't need to worry about that one, because companies who do have that abide by it and they live by their credit policy. That's fine. The second one, which you touched on now, is obviously where it is updated, but it is not applied. So you update the policy, the document's there, all the things are updated by your legal department or perhaps a attorney from time to time. So you've got the policy, everything's updated, but you just don't abide by it. And then the third one is when there's no. So I understand that a credit policy is sometimes could be cumbersome in terms of I need to look at this document again, or this document drives the process. But I think, in my opinion, the important thing about a credit policy is that if your credit person is not there for a day, or if a credit department is not there for a day, and a brand new person walks in, they should be able to look at that credit policy and know exactly what to do, how to do it, and who's able to sign that off, all of those type of things. Because that will drive the focus of the business, that will drive your risk appetite, that will drive the credit granting and terms you're going to be given, right?
It leaves no room for interpretation.
Okay.
Everybody understands. If you do this, that person is accountable. If you do that, this person is accountable, or this is the process, or you may not break this rule, or you may not override that process, or this person makes that decision.
Okay.
Let's use credit notes.
Yeah.
Everybody suffers from credit notes. Every business, they hate doing credit notes. But if you do have a credit note, who approves it?
Yeah.
Who signs it off? Who signs it off? Yeah. Is it the credit control department? Is it the sales department? Is it the finance department?
Sure.
Who is accountable for it?
Yeah.
And that your policy must encumber and clearly indicate who. And the nice thing is, don't say, Mr. Potgieter must sign off the credit notes. No. The group CFO. Now it's a title, adapted to a process, and everybody understands. So if the person goes in and out, they still understand
the title is still there.
That authoritative position is the person accountable for that specific activity.
Makes sense. Okay, so in terms of the credit policy, that is obviously something that we at Inoctico, we have got a template, a generic form of a credit policy. And that credit policy is obviously that we want to show you today, snippets of that as well, the actual document of what that looks like. Yeah. But for our clients, what we do is, first and foremost, we sit and we engage with those clients. We sit with them and say, what are all these things that you need to put into your credit policy? We consult with them because each credit policy is unique to each and every business. So from our perspective, we've got a sort of shell, a template of what we think should go into the policy. We will go and sit with the clients. If you're interested, have a chat to us, but we'll sit and consult with you and tailor make that credit policy to fit in with your business. And in terms of that policy, there's a whole lot of things I need to touch on today, just to brainstorm a little bit of why they are in there, what's the purpose of this, and things like that. So you'll see a credit policy come up and down in terms of the talking point, the actual policy that we've got. But let's kick off and talk about payment terms. Why is payment terms important to have in a policy? And I know payment terms is a lot of times subjective to the salesperson wanting to get an account on board, or this is a big account, let's give extended payment terms, or even a big company saying we only pay on 60 days. How does that affect your policy?
I call it payment terms. Because what lots of companies completely overlook when they get to margin calculation. They say, what is the cost of my product? What is the cost of manufacturing or delivering the product? But they forget about the cost of capital and the cost of collecting. So if you've got a 5% margin and you give 90-day terms, guess what your profit on that product is going to be? Zero. Because just to collect the cash is going to cost you more. And that's why it is so critical when you design the credit policy, is look at the average margin that you have and then say, okay, if I want to spare and save this margin and protect my margin, I cannot give terms beyond 30 days.
That makes sense. You know, in a normal environment, a credit policy would say, our company policy is only to provide 30-day terms or 60-day terms, whatever it is. But these days with, I'm so sick and tired of talking about the COVID event, but everybody's using that to gain extended payment terms. Now, you in the business, they need to decide, right, my margin is this much because I provide 30-day terms. This client now wants 60-day terms. You then have the scenario where you're either going to lose the client if you don't give him extended terms, or your margin is going to be squeezed. And I understand from a credit policy perspective, yes, there are authority levels where you can actually say, right, we're going to give you an extra terms or extended terms, whatever it is. But it is vitally important in your credit policy to state, our company policy is to provide 30-day terms, right? And if we go beyond that, these are the scenarios that can apply.
Yes.
That's fair to do in the policy, right?
Absolutely.
It should not be hindering your business, but it should be guiding your business in terms of what, where, and how.
If those extended terms comes in, be open with your client. Discuss it with your client. Say, we'll accept the 60-day terms. We will leave the margin as it is. However, you pay all the invoices in full and we do queries afterwards.
Yeah.
So now it is a give and take scenario. Now we're accommodating one another. But once again, make sure that those extended terms are controlled and approved by someone specific that understands the implications and can look at that client's, because we might say our average margin is 5%, but his margin in that instance might be 3%.
Yeah.
So it might be even more detrimental to your business if you do give extended terms.
100%.
So every client must be measured, but as you say, the policy is there to guide. So now you say, stop, extended terms, let's discuss it with so-and-so. That's the person accountable for the decisions around that.
Yeah, and the impact on your business is also huge if you're expecting to get the majority of your cash in on 30 days, and now all of a sudden the majority of your cash comes in on 60 days. I mean, you've got bills to pay, you're waiting for cash to come in. And I think it's just fair to have that discussion with the debtor at that stage and say, look, if you're going to want 60-day terms and my cash on my products can be out longer for what we originally agreed upon, we need to look at the price. I mean, it's just fair. And it is difficult to understand that to say, let's increase your price because you want extended terms. But there has to be a give and take scenario. You know, and the debtor is going to get his cash in way before you're going to get paid. He's going to be able to pay all his bills. And he still is not paying you because he's got additional 30 days. So there is a room, and I understand that from a sales perspective, it's perhaps not ideal because salespeople don't want to go and say, oh, we need to charge you more. They want the account on board, I understand it. But as you say, in the end, you need to look at your business, your margins. The cash is out longer. Are you still realizing that profit? And I think that's key in terms of payment terms and why it is important to have that specifically in the document to say, this is our company policy, our group policy. If there are things happening outside of those terms, let's talk about that. But that's the exception, not the rule.
And attached to that, settlement discount.
Yeah, settlement discount, obviously. If people still give that these days, then obviously that's something.
But don't engage on settlement discount on your maximum term of 30 days. Say, hey, we'll give you settlement discount if you pay me on 15 days.
Yeah, or 20
days.
days.
Pay me on 7 days, or you pay me on 21 days. Now, you're going to get your money in quicker, and at the same time, you're giving something back to the client as well.
So now you're negotiating. That's a good thing. All right, let's touch on the second point. The second point is reviews. That's something that obviously is in the credit policy as well. And the reviews of those customers can be ad hoc or it can be annual. And in my opinion, I think, it's difficult to say to companies, you must do annual reviews on all your debtors because it can be costly, firstly.
It is.
And secondly, it can be time consuming. But the problem with not reviewing those customers is that when you open an account, you've got a certain risk picture of
it's a snapshot.
At this point in time, when opening up the account, this is the risk I'm getting involved with. This is how this guy pays. Happy with that. Now, a year later, you've not done anything. What is the impact of that?
So if you don't review, you're going to have a surprise that you don't want to have.
Yeah.
The other day, I had a discussion with someone about a specific debtor that they've engaged with from a different level. It's an insurance level. And I said, do you understand who you're dealing with? And they said, no. I said, even in your world, you should review who you're going to engage with.
Yeah.
You're going to render a service to them. They're going to pay you for that service. But if you don't understand who you're going to engage with, you are setting yourself up for problems. If you don't regularly review that either, you might not understand the business changes. Look at these companies that have gone down lately. We can name them. It's just like a whole lot of them.
Yeah.
For different reasons. Stutterfits a year ago or a couple of years ago, it went down. Why? Because it was a family feud.
Yeah.
Edgar's went down. Why? CNA went down. Okay, they were part of the Edcon group.
Yeah.
But so we can go on and on and on, and then look and see that there's certain things that happened in that business. Now, when you do a review, see, are those things not happening in my debtors world right now?
100%.
Is it not a red light going on for me? And if you don't do reviews, how are you going to know that?
Yeah, and I think reviews is a funny thing, because majority of the people we speak to, when asked do they do reviews, they usually give us the answer, we do it ad hoc. You know, when the customer reaches his limit, or when there's an issue or something comes up, then we review it. And a lot of time it is too late to do that review then, because if something happens and you're made aware of it, saying there's an application or there's a judgment that was granted or adverse information, whatever it is, at that point in time, it is unlikely that debtor is still going to behave the exact same way that he did when you brought him on board. At that point in time, it's too late for a lot of things. He's already thinking, I'm not going to be paying you on time. I'm going to extend it because I now have this issue. So I understand from a cost perspective, but the cost to benefit perspective is, I think, what people need to look at in terms of the review. The benefit is that you're on top of the risk of your book. You understand the risk. You mitigate that risk through getting information and looking at that data periodically to understand, is this still the same company that I'm dealing with? The same risk, the same whatever. Because it is important to do that if you do not want to have a bad debt, if you do not want to have to write that off. And a lot of times, as I say, it happens, you get notified of it and then it's too late because you didn't get those warning signs, you didn't do that review, you were waiting for the guy to reach his limit or terms, and then only you want to look at it.
I'll wait for a car brakes to fail before I take for service.
Exactly, yeah. You wait for a crash before you want to do the brakes.
Yeah.
It's too late then. Okay, so that leads us to the next point in terms of the client risks. So in terms of the policy, we're looking at different risk levels of a client. And it is mentioned in the policy to, if it is a medium or high, whatever risk, and that risk can be determined by various ways. The risk can be determined by using a credit bureau, it can be used by an internal scorecard that you've got, whatever the method is. So that risk levels are then clearly defined in the policy. And at that level, it says, this is the risk of a debtor, this is what you need to get in order to open that account.
What's your appetite?
What's your appetite? And those risk levels will then guide, if we're looking at this company and he's a high risk company or he's a low risk company, what are we able to do?
Yeah.
And importantly, obviously, those things should be clearly defined in the policy in terms of what you need at what risk level.
Correct.
Because that will guide you to understand how you need to manage that account going forward. If it's a low risk customer, for instance, and the scorecard said is fine, fair enough, review him on 3 months or 6 months or whatever. But if it's a high risk customer, what do you do then if you open that account?
You see, and it's almost a discussion topic on its own, and we're talking securities here. Because now, if you stipulate in your policy that at certain levels of risk, you employ certain securities, understand that there's certain admin processes around those securities. Things that you have to do on a regular basis.
And we'll touch on securities as well later on. But yeah, I think defining the different risk levels in the policy is important.
Critical. Because if you don't define it, and even then, because the higher the risk, your margin should be adapted the same to that.
Exactly, yeah. Because you stand a higher risk of actually this debtor not paying you, of him actually absconding, of going away.
What then?
And yes, you can get credit insurance, and that's fantastic if you can afford it. But still, you are always going to have to carry some sort of risk. There's always going to be a portion of the event that you're going to be responsible for. So it is vitally important, I think, to specify those risk levels in the actual credit policy and to extend, say, what is needed if we're going to open up this account because of a risk level, and more importantly, going forward, once we've opened that account, what do we need to do in terms of managing that risk?
Absolutely, because if you don't have that, and it becomes hand in hand with your review process.
Yeah.
You understand the risk, and you can even say, high risk debtors we'll review every three months.
Exactly.
Medium risk and low risk debtors every 6 months. So now the whole lot fits like a hand in a glove with one another.
Let's talk about credit limits. And I understand credit limits is an issue because I've looked at debtors' books and I see customers having a credit limit. And then I see the outstanding amount. And I think, how do they get to this if they haven't done a review? And it simply could be because you've got an aggressive sales team that says, we need to sell, and it shoots over its limit. And I understand that process. I've been in sales as well. You want to sell, you want to get the maximum out of this customer. But if I have to put my credit risk hat on, a credit limit by definition tells you that you can only buy to that level. You have vetted the customer.
Exactly.
You have come to the credit decision that he is only worth this amount.
Maximum
Now you
amount.
don't exceed that amount.
Correct.
Why would you exceed that amount?
Yeah. You see, and it starts with the engagement part, when they fill in that credit application. The sales guy is thinking in a monthly basis. He says, how much do you want to buy for? That's a very straightforward question.
Yeah.
I want to buy for 100,000. But remember, that's only the current month.
Yeah.
He's only going to pay you in 30 days after that. So that's 2 months' purchases.
200,000.
What about a little query? So add another 50%. So 250,000 is what you're going to be exposed for before you get the first payment.
And I don't think they always get that 100% right, because from a sales perspective, how much are you going to buy? 100,000, let's do 100,000 in limit. He's not going to do that. You need to look at current, you need to look at 30 inquiries. I understand that. Salespeople, I'm not saying they don't understand it, but a lot of times they don't necessarily see that whole picture. So it is important from a credit limit perspective, obviously with sales and credit to engage, and the credit person will always ask, how much is this guy going to buy per month? Salesperson saying 100,000, the credit person will know, right, I need to probably do 200,000 or 250,000. But the other effect also, and I had a chat to a customer yesterday who's got a credit application for 100,000 Rand. Now they're looking for all the details in the report, bank code for 450,000. That's exceeding now the problem.
Yeah.
And I think a lot of times the credit people do that because they don't want to go through the necessarily administrative functions of doing this on an annual basis. So they look at it and say, right, this customer wants to buy 100,000. I'm going to give him a limit of 400,000 because I don't want to review him in 4 months' time when he reaches his limit, or I don't want to review him. And that's silly as well, because now you're exposing this customer to this massive limit that he doesn't necessarily want to buy. It is on your books, and your sales process is now driven to sell to that, where the overall picture right at the beginning should be, it is 100,000 Rand customer, not 400,000.
And if your product is not a fast-moving product and you've just given him 400,000 and he bought for 400,000, your product is going to sit there and he's going to think, why should I pay these guys?
Exactly, yeah.
His product's not moving.
Yeah.
So very relative, relate the product to the limit, to the time period, to the terms that you've given. All of this goes hand in hand.
100%. And that leads us to the next one we want to talk about, the mandates. Now, mandates in a credit policy is extremely important because the mandate will tell you who can authorize what risk level customer want to take on board, who can authorize the credit limit if we want to go over that.
Yes.
If I'm going to go over the credit limit, who needs to sign that off? I, as the credit controller, perhaps can't do it, but the credit manager can do it, or the financial manager can do it. So mandate levels, in my opinion, is probably the most important thing in the policy because it guides who can do everything or override everything in that policy.
Yeah. The levels of authority plays a major role in mine. I hear so many times credit manager says, oh, I can sign up to 5 million. I don't want to sign off to 5 million because I don't want to take that risk on my own. I'd rather engage with someone else as well that might see things that I don't see
differently.
So rather have a panel or 2 or 3 people that make decisions around certain amounts or greater amounts than a certain value and get as much information. When people say to me, I want a basic report. I say, what is the value? That's 5 million. I think, holy Moses, you want to base a 5 million decision on
a bank
trade reference on a bank code and no adverse information. What really is in that business that you should know that you are not going to see?
And that's 100% because the credit policy will also guide you in terms of what information you would need at what amount that you want to open.
Yes.
But the mandate levels, and I think it can be used as a very, very important tool as well. If you give a certain amount of authority or mandate to a credit controller, that empowers them to actually make that decision.
Absolutely.
And as this person grows, you can extend that level of authority or that mandate. So, right, more responsibility, you can now sign off 200,000 Rand. Adopt your policy on that. and make sure that it is updated. Because it's no use you just say, hey, you can now sign off for 200,000 or 300,000 rand. Audit comes in, it looks at the credit policy and says credit controllers can only sign off for 100,000. This credit controller sign off 300,000, and you're in the drag. So ensure that when you've got this policy, as we mentioned right at the beginning, adopt it and update it when you're going to
on a regular basis.
On a regular basis, right?
But it's also not just leaving it at credit approval. Also, when you've made the mistake,
Yes.
and you need a credit note to be raised, who signs off those credit notes? Because now you must remember, now you're touching on the profit again.
Yeah.
Because now you're going to take money and you're going to write it off.
Sure.
For you, the lack of using a different word, but it is taking away money out of the business, and not everybody should do that.
Of course.
It should be carefully mitigated,
Authorized to do.
and understand what was the root cause for that, because then you can start putting rules in place, maybe in your policy, to prevent that same thing from reoccurring and more credit notes happening.
Sure. When I started as an organization as a group credit manager a long time ago, I started and they had absolutely no credit policy. So I had to draft this thing from scratch. And I mean, I was young, I didn't have a lot of experience. I don't know where to go. So I walked around the entire business and tried to find out who's authorized to sign what off in terms of this mandate level. I got a whole lot of different answers from a whole lot of different people. Nobody knew. Some people said you can sign off this. Some people said you can't sign this off. So it is important to have that transparency in the business to
Absolutely.
say, if you have this limit and you have all this information that you need, go to this person, he's authorized to sign it off.
Yeah.
And that person must accept that responsibility and sign it off. And it also can include a lot of things like if you have credit insurance and the whole lot, put that in your policy so that you know exactly what to get at what stage. The next thing I want to talk about is the size of accounts, and that leads on from the actual mandate levels. The size of accounts that you bring on board will be in the credit policy, and in that it will tell you when you open up an account for 500,000, you now know who can sign it off. But in terms of the size of the account, it tells you what information you need in order to open an account. Right.
Absolutely.
Why is that important?
It's critical because well, we just spoke about it 5 minutes ago. If you have a certain amount that you're looking at, the smaller the amount, the less information you really need.
Less risk.
But the larger the amount, the more it's going to cost your business. Just imagine that debtor going under. And you know, people always talk about all your eggs in one basket.
Yeah.
But if you're in a small town and there's a mining business that evolves purely by getting certain things from you, and you live for that business, and they go back, and you didn't have protection against your risk or didn't understand your risk,
Sure.
you would have been in serious problems.
If the platinum mines close down in Rustenburg, Rustenburg will close its doors.
Absolutely.
Everybody will move.
Absolutely.
And that's a scenario that we're talking about. So, you know, the size of accounts is important because a lot of times I see people saying, I don't want to necessarily pay 1,000 Rand for a credit report or for whatever information because it's too expensive. But I want to open up a 5 million Rand account. Now, I think to myself, right, you don't want to spend 1,000 Rand on a 5 million Rand account. You would rather just look at the basic information because that's what you're comfortable with. But in my opinion, at that level, you would need financial information. You would need to look at those statements. You would need to look at the management accounts. You need to feel comfortable of giving 5 million Rand away. And I always think of it this way. If this was my money, would I be comfortable in giving it away with the information I have?
Yeah.
And a lot of times, if you ask a person that question, they're like, oh, no. Then they think about it a little bit differently. You know, if it's your money, would you be comfortable just getting a bank code and some trade references to give 1 million Rand away? I wouldn't.
And it's important to validate the information as well.
Yeah.
Trade references. Is it associated companies?
Yeah.
How would you know that if you just get the basic information?
Of course.
The more information you get, the more informed you are, and then you take an informed decision.
Yeah. And a lot of times, you know, the size of the accounts will dictate that you need to get a certain piece of information. Let's talk about financial statements, for instance. The size of account says at a 1 million Rand level, you need financial statements. Now you don't have the financial statements. I always look at credit and say, assess it on what you have rather than what you don't have.
Yes.
So if you don't have financial statements, look at what you still have in order to get to the decision. The decision might be that I cannot extend 1 million Rand. The decision might be that I can only give you 500,000, provide your financial statements, but you can still make that decision. And I think a lot of times people stare themselves blind in the fact when we're talking about size of accounts that it dictates that I must have this, otherwise I can't do anything. It's not that you cannot do anything. It's just that you cannot give that amount based on the size of the account according to the information that you now do not have. Look at what you have. You can still do business. You can still grow that customer. Let him run for 3 months, 6 months, see if he pays well. You can then increase his limit. You can grow that customer. So it's not a question of the policy again dictating that if you do not have this, you can do nothing. Look at what you've got, assess it based on that.
Appetite for risk.
Exactly. Right. So the next thing we want to talk about, I think we touched on that now, is what do you need in order to approve an account? And a lot of times people get confused in terms of if they don't refer to the policy, they're not really sure what it is, because you train me when I started this company and say, oh, I need to do this, that, and the next thing. There's no credit policy. Now I get a big limit that I need to authorize. And I'm thinking, well, the thing you taught me is still the things I need to get. That's why it's important to, in the policy, over and above the mandate levels, over and above the size of accounts. When you're talking about the size of accounts in a credit policy, state in there what information do I need in order to open this account. If it exceeds this level, do I need security? Who can sign this off? How should I manage this account going forward in terms of the risk appetite? So that obviously is also important in a policy, right?
Yeah, and even before that, there's a no-go area where a lot of people think, this is not really necessary, is make sure that your credit application document is completed in full and signed.
Yes.
Because the signatory says, I agree. Or if you do a service level agreement and incorporate your terms and conditions into your service level agreement. But make sure that whoever signs the document firstly has the authority to do so. And when they've signed it, that they've agreed to all the terms and not they've drawn a line through it. Because that's the first part of the engagement. So for any size account, for whatever you engage with, because there's certain laws in the country also guiding that. So make sure that happens. Then you start saying, okay, for this account, that's what you need. For that, that's what you need. And if it needs to be, let your credit team educate your sales team on a regular basis.
What they need.
As the necessity. And why is it that you ask for that? That it's not just to make their lives difficult.
And they always think that.
Because it is, I want to help you grow our business.
And I think it's an important thing you touch on there as well, that the sales director or the sales team have line of sight of what the policy says. Because the policy says, if Mr. Salesperson, you're going to bring me an account for R1 million, I need accompanied with that the financial statements. If the salesperson knows that right up front, when he goes to that customer and the customer says, I want R1 million, the salesperson can say, right, here's a little tick box of all the things I would need. Give me this with the application and we can go and assess it. They don't do that. So then they drop off the application, they back and forth, and eventually a week later or 2 weeks later, oh, now I need your financial statements. It is frustrating for the subject, for the debtor, because why did you not ask me this in the beginning? And that's why in the beginning we said line of sight being driven down from the C-suite, that everybody knows what we need, who signs it off in terms of an account. If you're going to bring me a R1 million application, bring me the CIPC documentation, bring me the financial statements or the bank statements. At Inoptico, we obviously have a whole lot of tools that can help you do that through automating that process, but that's not what we want to talk about. What we are saying here is that make sure that you always have what you need in order to open that size account, because it will speed up the process. There's no fighting between debtors and creditors saying, but Mr. Salesperson, you knew that we needed financial statements here. Make sure that they've got it. And it's easy to do a little tick box or just a little sheet for the salespeople and say, right, at this level to that level amount, this is what we need. At that level, this is what we need. Have it with them. They always have it. When they engage with the customer, Mr. Customer says you want R1 million. Okay, Mr. Customer, let me see. Right, I would need your financial statements, CIPC documents. Please provide that for me. Done, quickly.
Even you can put it on your website. If you want to engage with us and open an account, if you want to engage this level, that level, that
100%.
level, they can see all the requirements. And they know that you are a transparent business with rules in your business to protect yourself.
Exactly.
And how you want to engage with me as your debtor.
Right. So let's talk about monitoring and the review period of accounts. That's obviously something that we put into the policy as well. And that will dictate how you go about in terms of managing this account once you now have that account on board.
Yes.
And we touched on that early on when we said, you know, you've got a high-risk customer. You know it's a high-risk customer, you brought him on board. What should you do in terms of monitoring that account? You've got an average or low-risk customer. What is involved in the monitoring of that account as well? And there's obviously a whole lot of tools with a whole lot of companies where you can monitor that on a daily basis, and we do that reviews on a quarterly basis. But why is it important to monitor that account there?
If you do not monitor the account, especially if it's a high-risk debtor, can you imagine if something goes wrong, who are they going to look to blame?
Yeah.
And if there's no accountability stipulated around the reviews of that account either, then it's going to fall through the cracks and everybody's going to start pointing fingers in different ways.
Yeah.
But if it's clearly defined in your policy, the accountability of the monitoring of these risks, because you've got an appetite and you engage with high-risk clients, also have someone accountable for monitoring that.
100%.
But don't make one person accountable.
No, of course.
Because then you're looking for a lamb to slaughter.
Yeah, yeah.
Make sure that it's a team of guys and say, guys, all of us, these debtors that we engaged with as a business because of our appetite is deemed to be high-risk debtors. So let's watch them on a daily basis, weekly basis, monthly basis.
Yeah.
And if we notice anything, let's look at it. Let's investigate.
Let's assess it. Yeah.
Let's protect our business.
And I think it's important because a lot of times, when something goes wrong, there's always a sort of, let's refer back to the original account that was open. Let's look at the risk appetite of the account when it was open. And if you don't monitor these accounts as you should, dictated by a policy or whatever you want, when something goes bad and there's a judgment that the customer doesn't pay, then everybody jumps up like, oh, what are we going to do about this now? And as I said earlier on, you can proactively manage that by ensuring that you monitor these accounts on a regular basis, dictated by your appetite for risk. Because something goes bad and they're going to say, well, Martin, you opened up the account. What was your situation when you opened up the account? And you look at it and say, well, it was a high risk account and these people signed off on it. These people that signed off on it are not going to necessarily monitor an account. So you need somebody responsible to say, if we have a high risk customer, what are we going to do in terms of ensuring that that risk stays the same? Or not just the same, but improves. And if the customer's risk situation improves and he's no longer a high risk for whatever level, he's now a low risk customer. That can drive the salespeople to
opportunity.
Exactly. So the salespeople can now have an appetite saying, well, these were high risk customers. We were not able to engage with them because of the risk level, but they have now improved. I can now target these guys. Yes, we've got tools that will tell you the risk appetite movement from a customer from month to month and his risk levels and his payment behavior. Those are important things to have as available tools in your armor in order to ensure that you can monitor this and by the same time grow your book. A lot of times a customer is a high risk and a company will say, I'm not going to open up this account for this customer. But they don't necessarily look at why this customer is a high risk. If that information is given from any bureau, it's a high risk customer. Then they say, right, we're not going to open it. But if you see it's a high risk customer and you look at why it's a high risk customer, you might still want to do business with that client. Because if I look at a high risk customer and the reasons are the directors have only been in the business for a year and they have got no experience in this business. But those directors run a successful company for 30 years doing the exact same. They just started their own business now. That, in my opinion, is not a high risk. I want to sell more to these guys.
Exactly.
But the fact that you now only see it's a high risk and say, I don't want to do the business, makes you lose that account. It's a great opportunity.
That boils back to what we said just now. If you don't do the proper investigation in the beginning, you are not going to know that.
Exactly. Because it dictates in your policy, if it is a high risk, what information do you need?
Correct.
Get the information. Even if you're going to want to decline the account in the end, get the information so that you can properly assess that. There's lots of companies that we know of that deal with debtors that are high risk.
And
they've been
make money.
They've been making money and they've been dealing with them for years because they understand the risk they get involved with. They understand the appetite. They know what is required in order to open an account, and they monitor that customer on a daily basis. Any company you speak to, if you ask them who the companies who are not paying on time, they'll say, oh, these companies, they're bad, they high risk for us. It's not high risk companies. They're just not paying well. And they're paying well, not paying well for a reason.
Correct.
It doesn't make them high risk. So you've got risk levels in terms of business risk, and you've got payment risk as well.
Yeah.
It's something that we obviously define within Ignotica as well. But those things are what you need to look at and ensure that you monitor those guys.
And understand why they're there. And if it is a high risk debtor, not necessarily to payment, If you live in their backyard with them, you will know when something's going to happen.
Keep close to them.
But if you stay away from them
Yeah.
and just monitor them out from a distance, that's when you lose touch with that data.
Exactly.
So pulse, finger on the pulse.
If
all
you
the
have
time.
an active sales team, that salesperson can go and knock on that guy's door or just walk around in the warehouse every single month on your high-risk customers to ensure your risk is mitigated. So it's a good opportunity for the salesperson to have a look and see if I can grow this account.
Yes.
It's a good opportunity to get eyes on the actual business, go back to credit and say, we need to look at this because there's an issue, or we need to look at this because there's an opportunity.
Yes.
It's part of monitoring that. It's not just getting information from a bureau or doing a trade reference. Monitoring also means get in your car, drive to the company, look around, have a chat to the guys, working on the machines, ask their opinion about it. That's engaging with the customer and ensuring that that risk is mitigated and monitored to all levels at all times.
Yeah, credit control is not there just to manage and mitigate risk.
No,
They are there to grow the business.
that's what they need to do.
And it all goes around the information that you have.
Exactly.
So the more information you have, the more valuable it becomes, the more mitigated you are, and the easier it is to make a decision to grow the new
They're
business.
responsible to grow the business in a level where it's acceptable at the risk that they are.
Absolutely.
And those are the only people who can at one point in time say, let's increase this customer's limit, over and above the actual sales input. I see this guy's paying well, he's buying to his limit. Get a report, oh, he's low risk, there's no issues, he's paying everybody else well, he's buying big from everybody else. That's an opportunity to grow the book.
Absolutely.
So it's not just about doing the collections, it's about looking at the actual company. There's an opportunity here to increase this. What does my policy say I need to do? Get this information. I've assessed it. Hey, we can increase this company's portfolio because he's a good company. He's a good risk.
Absolutely.
Right? Okay.
Absolutely.
So the last thing we want to touch on here is then types of securities. And what we can do is in your credit policy as well is we can dictate what types of securities is acceptable for you, for your organization, for your industry. The securities does not necessarily overflow in all industries because it doesn't apply in all industries. If you think about securities like you have a lien, it's in the property sector. If you think about something like a session of debtors books, that's a nice thing to have, but the banks will probably have that. So listing the types of securities gives your people in credit and everybody else a guideline, and also your salespeople, a guideline in terms of what types of securities we can and would accept in the case where there's a high-risk customer and it dictates, if you want to open up this account, you need securities. Now, I don't know what type of securities. Your credit policy will tell you, these are the acceptable forms of securities we can accept.
Correct. And if you take a notarial bond, for instance, why would I take a notarial bond over an accounting company?
No.
They don't have
Pens
it.
and papers.
Correct.
No.
Well, I'll take the computers that have already got no value after 6 months. So understand what the security means.
Sure.
And understand what security it's going to deliver to you. But also, when you engage in securities, understand there's admin around it.
Yeah. Your responsibility on that security.
Correct. Make sure you understand that it's going to be a cost to your business
100%.
to manage those securities.
And that cost could be included in terms of opening up this account. If it's a high-risk company and you know that you're going to have to take security and you're going to have to manage that security, build all of that cost factors in your price. Because as you say, you've got a notarial bond. Now you need to go every single month and take stock of all the items that you've got on your general notarial bond to ensure they are still there, that they're still my security.
Correct.
If it's a session of a debtors book, you need to have access to that debtors book every single month to ensure the book value is still there. If there's a first session or a reversionary session and you're the second one, you need to understand what the first level is and what your portion is. So
Absolutely.
it's very admin intensive. It could be very admin intensive. Let's not say it is. It could be if you don't manage it properly.
Correct.
So if you have a bond over the property, that's easy. You don't need to necessarily manage that. That's an easy security to have, but not to get.
Yeah.
So the types of securities will also dictate to you, firstly, what you can accept. And then secondly, you need to decide how much admin am I going to want to spend on this security if I take it? Because a lot of people, and I laugh when they say this, is I've got personal surety, I've got security. And I think personal surety, okay, let's talk about utopia on a personal surety. You've got a personal surety. He's given you statements of assets and liabilities. He's signed and dated it. That is utopia in terms of personal security, because now you know what he's got. But that still means you need to go and check that he's got all those stuff, all those goods every single month.
Yeah.
Not only that, how many personal sureties has he signed?
As he signed, correct.
And yours is like last in line. So, you know, when it comes to people including personal sureties in their credit applications, I can understand why they do that. They want to have the people liable. But if you're going to have a personal surety in your document, any document, at least ensure that you've got statements of assets and liabilities. Because if you're going to get this guy to sign personal surety, you're holding him personally liable. His house, his car, and everything else is registered in his wife's name. It's not in the business, not even in his name.
All belongs to the bank.
Exactly. So what are you actually getting a personal surety for? Just to tick a box? No. Understand what the securities mean and understand your responsibility in terms of taking that security.
Managing that security.
Managing it. If you take a personal surety, ensure you've got the statements of assets and liabilities, it's dated, it's signed, that you can hold him accountable for that.
Absolutely.
If you've got a session of debtors book, look at that debtors book every month to see that it's still got its value. Same story with a notarial bond, same story with everything else that you got. If it is a pledge, by all means, it's great. Pledge the account in the bank or an investment account. And it's secured, it's fine. Ensure that it's still there. They're going to notify you if the accounts need to be removed because you're the pledgee. But there are certain types of securities that's easy to manage. And then there are types of securities that's very difficult to manage. And that will differ from industry to industry. Because as you say, you're not going to take a notarial bond on an accounting firm. Yeah. There's never going to be any issue with that. But if you've got a notarial bond on a steel company or on a manufacturing company, they've got a lot of stock in there. And stock moves on a daily basis. You are not there on a daily basis. So you cannot keep control of that daily, but you know that it's going to be admin intensive of managing that piece of security because that's what you took upon in terms of having this account. And those things might also change because when you open up an account, you say, right, we need this security because I'm not happy with the risk, I need security. You get the security, you manage the risk. Later down the line, you might say, right, I don't need the security anymore. I'm not comfortable with the account. Yeah. So you can relinquish that security, which frees up all that time, which means that customer is no longer on the high risk monitoring. It's now an average or low risk customer in our books.
And or even your client can you can have the agreement up front and say, we want to engage with you, but to give us comfort, let's have a notarial bond for 6 months. 6 months. Let's have a debtors session for 6 months. Then we review the account. So in 6 months' time, if this account is run smoothly and you pay me on time, I say, I can relinquish that session now. 100%. So it is all part of engaging with your debtor, but it must be well defined in your policy if you have that appetite. And it's not always easy to get securities because if I want to open up an account with you and you say, right, I need securities, I'm going, okay, fine, what securities do you need? But if I go to your competitor next door and he says he does not need securities, then I'd rather go there because his appetite for risk is a lot better than yours. Yeah. I'm going to do the exact same business. I'm going to buy the exact same product. I'm just going to have to give less to this company. And that talks to the appetite of risk and also your policy in terms of if you want to open up an account at a certain level for a certain amount, these people need to sign it off. And that's where that consulting process comes in. And it says, well, this guy's on the border, perhaps we don't need security. But that decision is not going to be taken by you, the credit controller. You're going to have a mandate level in here stating this person is going to take that decision because he runs the business. He's got that appetite for risk over and above what the credit policy states. So the reason I'm saying that is because everything in the credit policy should not be dictating how you do the business. It should be guiding you of how to do the business. Correct. Don't steer yourself blind against the fact that I now have a credit policy and I cannot do certain things. Yes. You've got a credit policy to guide you how to do the things, not what to do. Yes, there are certain levels of authority in there, but at each level in the credit policy, it says, this is the person who can override this piece of the credit policy. Correct. Because you need to be able to adopt to that because there's going to come a time when you want to do a business with a company who's got 100 judgments and we know of them. And in your credit policy it now states if a company's got more than 5 judgments, you're not allowed to. Or if it's got any judgments. Now you sit and say, well, I can't open up an account for Nedbank because they've got judgments. You know, it should be guiding you, it should not be restricting you. And that's the reason why there's a credit policy to ensure that if you have that question of, can I do this? The policy will tell you, yeah, you can do this. Get this person to sign it off. Get all the information, get it together,
go to the CEO and say, this is the scenario, do we want to do business with this, yes or no? And get it signed off.
Process, control, accountability.
Exactly.
Fantastic.
Okay, I think we've touched on a lot of points. I'm not sure if there are any questions or any queries at this stage. But if there are
questions, but
sure.
do want a copy of the credit policy.
Okay, so I think in terms of a copy of the credit policy, because it is unique to each and every business and because it is bespoke to each and every one of our clients, get hold of us, pop us a mail, let us have a conversation with you so we can give you a copy of that policy in consultation to draft it for you. It is obviously something that we do as a business. It's something that we would like all our customers to have. And we will sit with you and talk you through the process and ensure that everything that we've touched on and more, because these are only a couple of the points, will go into your policy. So get hold of us, pop a mail through to any of the contact people, myself or Martin or Fatima, and we're happy to sit and consult with you and go through that process.
If you look at what's happening right now, the increase in liquidations, insolvencies, business rescue, that tells you that there's risk out there.
Yeah.
And if it's not probably mitigated and controlled and managed through a policy, it's just going to balloon even further.
No, of course. I see a stat here from Stats SA saying that business rescue has gone up by 37.5%. It's 37.5%.
And you know, business rescue doesn't go through a court or anything like that. It's not a controlled process. They go to a business rescue practitioner. They say, I think my business is in the state. The business rescue practitioner looks at it briefly. He sends out communication to all the creditors and say, my client has approached me. We're going in business rescue.
Yeah.
And now you have a problem.
And I think they just released the unemployment rate at a record high as well.
34%. 34.
I think that relates roughly to 13 odd million people over the age of 18 that is jobless.
They said America went into a complete recession at their unemployment level, I think, was 14%.
Yeah, we're at 34.
We're at 34. We're in serious trouble.
We're in a depression, definitely.
We're in serious.
All right, I think that concludes our talk for today on the credit policy. As I said, please get hold of us if you have any questions. We're happy to guide you through it, but in terms of our talking points, there is a solution that we offer. It's part and parcel of what we do. We're happy to engage with you in terms of your credit policy. So we will toss a coin who chats to them between you and I. And yet we're happy to engage and sit with you and talk through the nuances of the credit policy and to tailor make it specific to you, because just to give you a copy of the credit policy will perhaps confuse you because there might be things in there that's not relevant to you or your business. So get hold of us, have a chat to us. We're happy to consult with you, draft your credit policy, do it for you so that you can implement it so that it can guide the important things that we've touched on today.
Correct.
Perfect.
Johan, thank you for your time. I think it was an interesting
discussion. If there are no other questions on there, we can conclude this, but by all means, if you do have questions, send them through to us, pop us a mail, we'll answer them on an individual basis. But yeah, I think it was a good session.
Or if there's any credit related questions, don't just leave it around with credit policy.
Sure.
We've
got some experience
and we can assist you.
Happy to do that.
Thank you for your time. Have a great day.
Thank you.